It's not a terribly novel idea. Preservation funds have been around for a while, but I will say it kind of came to us organically from just recognizing themes of conversations that we were having with our existing LIHTC developer partners.
Welcome to BuzzHouse, a Baker Tilly podcast where you can hear all the buzz around multifamily housing, with all the info you need to help you win now and anticipate tomorrow. Hi, I'm Don Bernards, the partner in charge of Baker Tilly's multifamily housing practice.
And I'm Garrick Gibson, a partner at Baker Tilly, also specializing in consulting on multifamily housing transactions across the country.
Let's get started. Garrick and I work on many low-income housing tax credit projects and historic tax credit projects. So the source of equity is from the limited partner who, of course, is interested in the tax credits. Garrick and I talk a lot, receive many calls from people who are interested in finding other equity sources for acquisitions of what might be year 15 projects, naturally occurring affordable housing, or some similar asset type. It appears that this is a space that our industry has got some focus on, our industry being the affordable housing space, and looking to preserve affordability, of course. To this point, we're very excited to have with us today Brian Fishback with Redstone Equity Partners, who'll be talking specifically about their Preservation Housing Fund. And Brian, thank you very much for joining us today.
Yeah, thanks for having me. Excited to be here. I always like hearing what you guys have to say about the industry and what's going on. So thanks for having me.
Very good. Before we jump into our discussion with Brian, just want to hit on one recent piece of legislation that was introduced. Of course, there's been a lot of discussion around the Affordable Housing Credit Improvement Act, which we'll have another podcast on about coming up. But I really wanted to alert you about the Workforce Housing Tax Credit Act. So again, the Workforce Housing Tax Credit Act introduced in the Senate and House here in December of 2023. And a couple of quick highlights about this act. The credits would be allocated by state housing finance agencies through a competitive process, so very similar to the 9% tax credit, 4% that might be competitive for states. It'd be a 15-year compliance period. The credits would be provided over a 15-year period. There'd be a $1.5 million small state minimum set aside and $1 per capita. There's just a lot of details that we can probably get out there, and if you have questions, reach out to us. We're going to definitely keep on top of this legislation. I think there's some other interesting things in the legislation is a state could change this middle income housing tax credit, exchange it for more 9% tax credit authority. So a lot of nuances, I think one other interesting thing is you could combine this middle income housing tax credit with the low income housing tax credit in the same project even. So a powerful project both for workforce and then tacking on to potentially your LIHTC project as well. So again, Garrick and I will stay on top of this and let you know what's coming out of Washington on this front. With that, I'm going to turn it over to Garrick to jump into our conversation with Brian. Garrick?
Thanks, Don, and thanks for that intro and discussing the new legislation that has been put forward. It sounds exciting. But now let's just begin our show. So Brian, welcome. To begin, Brian, before we get into specific questions, would you please tell us a little bit about yourself and Redstone Equity Partners overall?
Yeah, sure. And thanks again for having me. So I was born and raised in Springfield, Missouri, went to school there through high school and moved to Indianapolis, where I went to college and did my undergrad and MBA and played soccer there and met my wife, who was in nursing school and was from Indy. After college, I kind of finished my CPA, got my CPA license, and went and started my career at a local accounting firm called DOZ, who is now much bigger than they were at the time, but they specialized in affordable housing. And so that's really how I got my start into the industry and have been in this field ever since. And there I did audit, tax, consulting work. We helped build an underwriting model that we sold to a few syndicators and used as a consulting tool for our developer clients. In that project, I kind of realized that I really liked the front end side of the deal making. You don't have to operate in the black and white as you do in audit and tax, and you can kind of hover around the margins and be creative. And so at that point, I kind of realized I wanted to go do something else. And I found Redstone Equity Partners and moved to Charlotte, North Carolina in 2015, where I've been ever since. And about Redstone, we're primarily a LIHTC syndicator. We've been around over 15 years, have over $10 billion in equity under management, which is somewhere over 60,000 affordable housing units across the country. We also have renewable energy platform, roughly $500 million or so. And that's primarily utility scale solar facilities. And then, most recently, we've really been looking at expanding into various congruent lines of business where we can utilize our expertise in underwriting and asset management. And, as we think about these things, it's kind of, do you want to go more tax-oriented investing like renewable energy or new markets type stuff, or do you go more real estate focused based on our expertise? And so this kind of affordable non-LIHTC equity line is one of those business lines that we're currently really focused on.
Thanks for that, Brian. And that's actually a pretty good segue into my first question. So, as you're expanding and maintaining non tax credit type real estate transactions, where did the actual idea of coming up with a preservation housing fund come from?
Yeah, it's a good question. It's not a terribly novel idea. Preservation funds have been around for a while, but I will say it kind of came to us organically from just recognizing themes of conversations that we were having with our existing LIHTC developer partners. We started hearing a consistent narrative around things like, hey, we're running into taxes and bond volume cap issues in states that this was never previously an issue. And so they felt like they had good deals at the ready, but they had to figure out some other funding source or some other way to build the capital stack because they couldn't get an allocation of bonds to go do a LIHTC deal. That's where things like the Affordable Housing Credit Improvement Act could really help reduce that 50% test down to 25. But in the meantime, that was one of the big drivers we were hearing. And also just kind of as debt markets tightened up a little bit, I think there became a broader equity gap in acquiring some of these properties. You're not going out and getting 95% loan to cost on this stuff anymore. And so there became a real equity need in this market. So, initially we looked at a ton of ground up stuff. A lot of our developer partners were saying, hey, we're trying to build the same product we're going to do in a LIHTC space. We can change the tenancy around or move it around a little bit. Those deals are really tough to pencil in a market like it is today, right? Again, with lower leverage and a lack of soft sources like you would get in a LIHTC deal, they're just really hard to make pencil. Obviously, the country's going to need those deals and need new units to get out of the affordable crisis, but it is certainly a tough time to get them done. And then we were also seeing a ton of bridge to LIHTC and resyndication type of opportunities, which became a real focus and something that I really like in general. And we can certainly talk about that later. So as we kind of started, compiling some pipeline and having more of these conversations, we felt like we could really offer a compelling risk-adjusted returns to our investor partners and come up with something that we felt like they would be interested in, and all the while furthering our mission of creating and preserving affordable housing across the country.
Perfect. Brian, thanks a lot for that background of the fund. Maybe kind of starting to dive in a little bit to some of the specifics. Our next question is, what type of assets, are you looking for? Perhaps you could discuss asset type being, is it year 15? Is it Section 8? Is it naturally occurring affordable housing? Is it other, maybe, income affordability? What kind of AMI bands, and even maybe geography? What parts of the country are you looking in? So,
yeah, a lot to unpack there, Don. I would say all of those are asset types we'd look at. At a minimum, we want the majority of our units and properties to have rent and income restrictions, at or below 80%. We don't necessarily need deed restrictions like you would get in a LIHTC deal, but we'd want something in our LPA or some other document kind of documenting what the anticipated unit mix would be. I also, in some of those, I want to make sure that we aren't investing in kind of market rate housing in disguise. And by that, I mean, in terms of affordability, there are a lot of markets in the country where 80% AMI is close to fair market rents, right? So if we're saying, hey, we're doing the bare minimum for getting over half the units at 80% AMI, I'm still technically qualifying for what could be a CRA investment under the public welfare investment test. But really, that looks more like market rate housing, and it's not really kind of the affordability restrictions that we're really focused on. So affordable is a very broad definition. I think we can all agree on that. But when I am looking at deals, I really am looking at the tenant burden on the rents, right? I kind of want to see, hey, of these income bands, what percentage of their income would be needed to pay rent and utilities? And I kind of look to the FHA definition as I want that to be at or under 30%. Now, that doesn't have to be for all the units, but I would like to see that for a majority because I think that is really what we're going for here. I think you also asked about geography. I don't have any hard and fast geographical restrictions. I think it's more looking at markets where our operating partners have expertise and boots on the ground, because we're really heavily reliant on them to operate these properties. And I also think we're looking for markets with just strong metrics and growth drivers in them. Going back to kind of asset types, I think all those ones you touched on, Section A, Year 15, NOAA, all those come into play. We will look at true value add plays. I tend to find those are much harder to execute in practice. And from a sheer philosophical perspective, I'd much rather look at opportunities to grow NOI organically as opposed to putting pressure on large rent premiums that are ultimately going to get passed down to the tenants. The presence of subsidy in those types of deals helps because it offsets that additional rent burden. But I'd much rather look at stuff where there's some programmatic structure to help grow NOI. And, there's several states out there that do real estate tax abatements or pilots, stuff like that for structuring considerations, whether that's rent and income restrictions, could be non-for-profit participation, et cetera. Places like Texas, Colorado, Florida, the Carolinas, they all have something in place. And there's much more states than that. And I will say I continue to see states put emphasis on those types of programs if they're starting to see that, there's a real need here. And I just like those programmatic opportunities because I really am a firm believer of public-private partnerships. I think these deals they work better all around if a locality is involved and on board with the project.
Perfect. No, thanks for hitting all those points, Brian. Next question, Brian, a ballpark size of project would be you're looking for, or maybe a better question might be what size, equity investment works for you. And again, maybe you could touch on in planning, we talked a little bit about what a GP co-investment looks like. So maybe just touch on that a little bit as well.
Yeah, I think our sweet spot for an equity check is somewhere in between 5 and 15 million, I would say. We look at stuff that's smaller or bigger. It just kind of depends on the sponsorship and overall impact of the investment. I think anything over 15 has potential to cause concentration issues in a specific fund. There's certainly ways to work around it, but that's one issue with really large checks. And on the other end, if you go anything under 5 or really small, a lot of times the juice isn't worth the squeeze there in terms of the resources that we would have to allocate and time you put into those. Again, I'm not saying we wouldn't look at some of those, but those are kind of soft parameters, I would say. On the GP co-investment side, really what I'm looking for here is a meaningful commitment of dollars from our operating partner. This is a different structure than a LIHTC deal where our partners are earning their fees largely through fees, right? Like through a GP management fee or a developer fee specifically. We're not looking for someone to build or rehab and then get out kind of thing. We're really looking for someone to kind of come hand in hand, put some meaningful capital in with us so that we have aligned interest through the hold period. And I would say that's typically 10%. It's usually a 90-10 split of the equity gap is what I typically see. And that way, our sponsors are putting in 10%. We're typically getting pro rata returns up to some hurdle, and then they get the carrot of a promote or a disproportionate share of economics after those thresholds are met.
Yeah, Brian, thanks for illustrating kind of that investment protocol. What about like underwriting metrics? Could you discuss some of those, such as loan to value, debt coverage ratio, any needs for capital, like a capital needs study, and how you factor all of this into your underwriting of the acquisition?
Yeah, that's a good question. I would say this space I've found isn't, again, quite as black and white as some of the LIHTC stuff that we have, where there's specific AHIC guidance out there on what some of the stuff should be. I think we play into that a lot in our underwriting guidelines. We'll start with debt. I think we're looking at, I like to see leverage levels at least under 75% of loan to cost or loan to value if you're doing a refi or something. But preferably, I like to see 60 to 65% and about a 120 debt service coverage ratio is kind of where I like to sit. And this kind of plays back to the equity check size discussion. I mean, it's hard to generate a meaningful check size in a lot of these deals if it's a 90% levered deal. There's just not enough room for a third-party equity provider in some of those. I will say that the debt options in this space have grown substantially in recent years. I feel like Freddie and Fannie both have attractive options at this point. And a lot of our investor partners have agency lending platforms as well. And this also doesn't tend to be a space like in LIHTC where the equity investor also needs a construction loan or something like that, or it's paired. I mean, this definitely is not that type of a situation. I guess the other thing I would touch on debt would be I do like to see terms longer than our anticipated hold period. I mean, we will look at bridge to perm or a bridge to a mini perm type of a scenario, but I tend to look at those refis pretty conservatively. What I don't want to do is rely on excess refinance proceeds to return some portion of our capital in anticipation of getting to our minimum overall return hurdles. If it plays out in actuality, that's great. I just don't want to rely it on upfront underwriting.
No, that makes sense. And that's actually kind of lends itself to my next question because you mentioned you're looking at a more conservative refi and not necessarily return that capital. So, in terms of exits, what does an exit look like in the structure? You are anticipating these going into a tax credit transaction, or is it through a sale at some point in the future? And do you go into these transactions with any specific like exit or length of holds in mind?
Yeah, I would say this business line tends to have a really big focus on the exit because we're still having affordability restrictions. These aren't throwing off huge annual cash flow dollars, right? I mean, we're talking somewhere in the probably 5 to 8% cash on cash return in a year, and sometimes lower, depending on the business plan. So I would say I look at any hold period somewhere between 2 and 10 years. I mean, we aren't the type to just get something built or rehabbed and get out immediately. I mean, it is patient capital, but we can't be around forever either, right? So I'd say anywhere in the 2 to 10 year bucket is something we would look at. In terms of exit, I mean, first and foremost, kind of going back to our mission here, we really want to preserve affordability in these projects. We don't want to lose units to market if our exit plan involves a true sale of the property, right? We want to make sure that those restrictions are going to be in place. The tenants are kind of safe where they're at and can stay in their homes. You touched on the bridge to resyndication. I do like those deals. Oftentimes those are going to require subsidy being in the deal because the LIHTC resyndication, for you to qualify for acquisition credits, you're going to have the 10-year hold rule. And subsidy is a good way to break that. Likewise, you could look at GP interest purchases. Those are definitely something that I find interesting. They come with a little more hair on them. There's a lot of nuances to those, especially if there's an existing LP in the deal already. But that is a good way to keep these properties and get them in or back into the LIHTC program. I also just like that because it assures that affordability is maintained if a resyndication is the anticipated exit. And I think we are well prepared to look and underwrite that exit scenario, right? I mean, we look at, I don't even know how many LIHTC deals a year anymore. So I feel like we're pretty good at understanding restricted versus unrestricted appraisal prices going in, all those nuances that come along with a LIHTC resyndication. I feel like we're well suited to underwrite that. I would also say that in practicality, we are working primarily with existing LIHTC sponsors that we have previously executed with. And most of those operators are not used to selling assets. I mean, in the LIHTC space, they are long-term holders of this real estate. And so it's really important for us and them as partners in this deal to make sure we understand what that exit scenario looks like and what an LP interest purchase may look like, right? So that could be something like, hey, let's go through what the debt or capital markets would have to be. If it's not a LIHTC resyndication and you need to get us out, what do the debt markets have to look like for you to refinance and get us out? Or what would that check look like in X number of years? And so I also like to make sure that we're abundantly clear on kind of what that exit plan is, because anyone can take a cap rate and put it on NOI and make the numbers look good in Excel. But we want to be much more intentional than that and have a strategy around the ultimate exit.
That makes perfect sense. Brian, maybe switching gears a little bit, and just obviously interest rates are a topic of conversation all over debt and things like that. But really, we saw, right, the long year and a half interest rate climb every quarter, 50 basis points, whatever. But now, right, here we are in January, and we saw rates come down in December. Is that affecting your yields? Is it, or not so much? Or we talk a little bit about that and how interest rates are kind of affecting what your investors are looking for. Because we know in the LIHTC, we know LIHTC pricing has gone down with interest rates rising. So just curious, what's the correlation kind of thing?
Yeah, sure. I don't think it necessarily is kind of a one-to-one correlation like it is with LIHTC. I mean, I'm really paying attention to what cap rates are looking like in various markets, and actually even more so what replacement cost is in a lot of markets. I will say rates do obviously have a direct impact a little bit on maybe what our hurdles on, but more so on just it's a strain on the capital stack in general in these deals, right? Like I said, you used to be able to go and borrow 80, 90%, and that those leverage levels are just much lower now. I think our expected gross deal level returns are still hovering anywhere around the low to mid teens is probably how I'd look at it. But what I do hope, like I would imagine most everyone else in the industry does, is that the bid ask spread narrows a bit as we move along in 2024 so we can start having some better clarity on pricing in general.
Perfect. And Brian, really just one last question for you are, first of all, are there any other considerations you'd like to let our listeners know about? And then also, what does 2024 look like for your fund? What are you anticipating?
Yeah, I think we've touched on a lot of the biggies. I would say I do like to see tenant services involved in a lot of these transactions, similar to the LIHTC side. I think social services and just having economic mobility for tenants is a big focus for us. So I always like to see that in our projects. And, we want to feel good about the impact of where our dollars are going. For us in 2024, I mean, I think it's not just a single fund necessarily, but we have had several investors show some interest in proprietary investments and multi-fund investments. So I think it's broader than a specific fund, but I'm hopeful that we will be able to, going back to your question on types of assets, I'm hopeful that we'll be able to kind of spread around and look at and deploy capital on a lot of those different types of assets. It helps disperse risk if it's not a single sponsor or a single market or a single asset type. So that's really what I'm looking for. And I think we'll continue to see interesting opportunities from kind of the existing market disruptions, interest rate levels or debt maturities, stuff like that. So I feel pretty good about where we are right now coming into 2024 with some capital at the ready to deploy.
Very good. That's it for this episode of BuzzHouse. A big thanks to Brian Fishback of Redstone Equity Partners for joining the show today to give us an overview of their Preservation Housing Fund. Thanks very much, Brian.
Yep. Thanks again for having me, guys.
Once again, I'm Don Bernards.
And I'm Garrick Gibson. Don't forget to subscribe so you don't miss an episode. For additional resources around multifamily housing, check out bakertilly.com. If you have a suggestion for the show, email us at build@bakertilly.com. That's BUILD @bakertilly.com. See you next time on BuzzHouse.